Good morning, everyone, and we're here with the Holy Macro Show. So, first off, we just want to start with silver. We've been talking about silver for a while, and there's things that Kashop and I will waver on about being bullish or bearish on. We both have different trading strategies, different time frames, and so on. But at the same time, we've been both very bullish on silver. For me, I'm like the trend's up, positioning looks right, the macro makes sense. Kashop seeing it from a macro angle and a fundamental angle. So, I think the setup here is still for silver to go higher. I can't see any reason why silver would slow down or start to reverse its trend. Kashop, what are you thinking about silver here? Do you think this thing could go a little bit further, or do you think it's talk about the valuation of silver? Talk about why it is where it's at today, where it could end up, and where it's going.
Hey everyone. I hope my audio is a little better this week. So I've done some things to fix it. So if you notice anything different, just drop that in the comments. And speaking of silver, the difference between gold and silver, although they are both monetary metals, is that silver, most of it gets used up, whereas every ounce of gold that's ever been mined is still somewhere sitting in someone's vault, in a piece of jewelry, or in your electronic trash, which gets recovered pretty quickly. So all the gold that's ever been mined is sitting above the surface, or below the surface if you consider it's in a vault. So it's all there. Whereas with silver, because of its industrial use, it gets used up. And silver, because of its value, it doesn't get recovered as quickly from landfills. It doesn't get recycled as quickly. So what happens is silver moves more with mine supply and investor demand, and let's say physical demand, than gold. So gold is purely about its monetary characteristics, whereas silver moves because of its supply demand balance as well. And if you look at the data the Silver Institute puts up, you can see that silver it has spent the better parts of 2 decades being in a physical supply deficit, meaning mine supply is not enough to keep up with the demand. So in a situation like this, it's just a matter of when silver starts moving, not if. And that's pretty much what we are seeing today. So silver's touched $50 twice before. The first was the infamous Hunt Brothers Corner back in 1980. That was the peak of the bull market in precious metals for a long, long while. And the second was in 2011 when it topped out in September. So gold had topped out in April, and then silver topped out in September, and that was the end of that bull run. Now, this is the third time that silver's broken past $50, and this time it looks like it's going to sustain. And the reason for that is, firstly, if you ask any technician and you pull up a long-term chart and you ask them, is there something called as a triple top? They would tell you, no, there are no triple tops. So this is the breakout that we have been waiting for a very, very long time, and it's happening. But now this is a multi-decade chart where you can see this breakout. Now, if you zoom in and you look at the daily and the weekly and the monthly, you are going to see a lot of back and forth. It's not going to be clean. It's not going to be straight. It's going to be the kind of move that will take a while. And by take a while, I mean it could be months, it could be weeks. But when it happens, 50 is going to be a firm floor, and we're not going to see silver go below $50 again in this cycle. So I think that's where we are heading. And it makes absolute sense that we are going to be seeing this in this environment as well, because not only do we have so much inflation, but gold has become unaffordable for a lot of people. So, especially in India, where people used to make gold jewelry before, now they're making silver jewelry, or they are dropping down to 18 karat and even 12 karat. And the reason for that is, well, gold is priced so high. What do? You still need to make jewelry. What do? Well, okay, let's go with silver. So this is kind of the rising tide that lifts all boats. So when gold skyrockets, it's going to take all the other monetary metals along with it for a ride, and that's what's happening. So fundamentally, it's great on the investment side, and secondly, we are seeing a lot more demand for solar power. It's just growing and growing and growing. So silver lost its industrial use case when the photography industry shifted from the physical cameras to the digital cameras. So when that happened, you no longer needed the silver film. So for the silver use dropped, and now solar photovoltaic cells, they need a lot of silver, and all the electronics, they need a lot of silver. So you are seeing the demand for silver pick up in the physical space as well. So it's a perfect cocktail of higher investor demand, higher industrial demand, and shrinking mine supply, and deficits for decades in the past, and deficits probably for decades in the future. So we are seeing all the ingredients for an explosive move, just that because it's a triple top, or it's starting to break from the triple top formation. It's going to be a long while before you can say that 50 is definitely in the past. We are going to see a lot of back and forth, and just don't get shaken out.
Yeah, no, I agree. I think you understand the volatility of each product you're trading is always going to be the most important thing, especially when you're looking at commodities, because a lot of these move in big ways. And especially when you're looking at stocks like Kashab is looking at, if you're looking at these micro cap names, they're not gonna move like the S&P 500, where you're gonna see like a 3% down day, everybody's losing their mind, these people basically jumping off of bridges at that point. Like you're basically 3% down day in an Explorer stock is basically just kind of normal. That's within a normal range of an uptrend. You can have 10% moves up, you can have 3% moves down, you could have 10% moves down, you could have 20% moves down. Like this is normal. So be used to it, be ready for the volatility. So I do think that this breakout here, it's going to be volatile. I think it's going to be a little bit hard to regain that level. And one thing I want to add too, you talked about triple tops. Triple tops, when people think of that and they go, oh my gosh, I've seen that before, and they think of a flag pattern, or like people bring up copper recently. And like when we're talking about triple tops, like we're talking about these long-term triple tops. This one being, I think it was 1980, and then 2011 is the one you see on your screen, and then today. So long-term triple tops usually don't happen. So I think this is the breakout that we've been looking for. I think this thing's going to continue to go a lot higher, and it's targeting about $100 pretty quickly. So we'll see where that goes. Once again, technical analysis can't tell you the future, just tells you what to look for, but it looks like an explosive move has just started. Freely brought up a question, and I was like, I'm going to get to that because it's a pretty good one. So if we're looking at this, basically he's talking about how does a halt in the CME affect your commodity futures contract? So basically there's limits to how much a contract can move. Like for example, some contracts can be 5%, 10%, 20%. I forget what the S&P 500, the E-minis are, but they actually halt that too around, I think it's like 10, it might be 9%. Do you know anymore, Kashab? It changed after 2020.
No, I don't know.
Yeah, it moves around, but it's around, it's somewhere between 7 to 10%. So basically, if you have a bunch of drops within a day and the S&P 500 drops in a quick way, next thing you know, it'll stop and trading will be halted until it gets back above that level. Kind of ridiculous, but it is what it is. Futures contracts, same thing. If you're looking at lumber, like lumber, I think it's 11%. Copper, I don't actually know what coppers is or even if it has one. So that's one that's interesting. But like a lot of them have limits, like the basically the amount they can move within a single day, up or down. There's up limit and down limit, so that can happen too. So basically, how does it affect me as a trader? I know that like if I'm trading something illiquid, because this doesn't happen most of the time. Like maybe extreme situations like COVID, you could see a bunch of them. But if we're going to like something that's extremely illiquid, like lumber, this happens quite a bit. So I know that in lumber, so I size my positions based on that. Like, because you have to start to think, okay, well, if I have 5 limit down days, which has happened to me in lumber before, how will my account blow up? How do I position myself? So you have to have your positions to a size that it makes sense. If you're trading something like that, which is why like I don't really recommend a lot of people trade things like lumber and so on. Like you really got to understand it, because most people trade too big, and that's just honest. But if you're trading at the right size and you're trading something like lumber futures, and you go, okay, well, I know I can have this many limit down days, I know that this could be a 30% drawdown, even though, like, let's say normal volatility will be around 20%. And let's say 30% would be a 5-day limit down day order, which could happen. So if you have all these limit downs and let's say it's gapping past your stop, I just have to take that into consideration as, okay, well, this position has to be even smaller. Instead of my, catastrophic stop being 20%, I need to move it to 30% and be ready for this craziness that could possibly happen if I'm going to trade these style of contracts. Once again, don't recommend that for everybody, but it's definitely an interesting one. But great question. I'm always excited to have conversations about futures because, not a lot of people trade it, but we do, and we like to talk about it. So
So I
next,
think
go ahead.
Freely's question was due to, so what happens to your positions when there's an outage? So how does that affect you?
Oh, he
It's not
added
just about the individual questions, the individual contracts getting halted due to volatility, but something like an exchange-wide outage.
Okay, so this halt was due to an outage. Does the same rule of thumb apply? Yes. So you always have to just understand this, that can happen, and that's the reason why these exist. Like, there's unforeseen events that might happen, and you might not be able to get out of these positions. Is what the most important thing to do or the most important thing to think about is, like, if you can't get out of these positions because it's halted, what would you do? And so the answer is most of these contracts this doesn't happen much. But if you're in very illiquid stuff, like, it's going to happen. Like, even the S&P 500, when it hits a limit halt, you basically see bounces. Like, it's going to bounce off of that level at some point and usually start to get bought around that level. And then it's trading for the rest of the day. Things like lumber, I've seen, I've been in 5 or 6 days that were just straight down and there's nobody getting out of it. So understand what you're trading. Like, if you're in like crude oil, it's never going to happen to you. If you're in copper, it's never going to happen to you. Gold, silver, never going to happen to you like that. Lumber, maybe like things like butter futures, milk futures, like some obscure contracts overseas in Europe and so on, like, it can happen. So like, that's why I would suggest if you're trading futures, trade the big contracts first. Not like meaning big as in size, meaning mini and micro. Crude oil is fine. Mini and micro natural gas, great. Gold, silver, copper, the e-minis, and so on. Basically, like, all of those big contracts, you're going to be just fine. You're never going to deal with any of that. But if you're in these smaller contracts, you're going to deal with it. And you just either have to understand, like, that's part of the game and size appropriately, or just decide, hey, I'm not going to trade them. I've seen successful people do both of those. I'm the person who's like, I'm going to trade these things. I don't care. And I'm going to size my positions to it and size even smaller. And I found that I make really good money that way, because sometimes these are the contracts that make the most money. But at the same time, I've seen plenty of people just say, hey, it's not worth it for me. If you're a big fund, you can't do it. Like, big funds do not trade lumber. Big funds do not trade like butter futures and some of these obscure contracts, HRC, cold rolled steel, and so on, things I talk about from time to time. But it's also, if you notice on Against All Odds Research, on my Substack channel, you'll notice that I never recommend trading these things for the most part. Like, these aren't like recommendations I put out to trade these very illiquid contracts. I used to talk about them a lot more. I talk about them a lot less, mainly because I don't want people getting into it who don't know anything about it. Institutional clients do get that research, but that's also because that's what they're looking for and that's what they want to do. So let's hop to the next one. So looking at emerging markets and the dollar. So we're talking about the dollar a little bit today. Everybody's like, people keep talking to me over and over again. Of course, really, anytime. And anybody who has questions, feel free to drop them anytime. Try to get to them as soon as I can. Looking at the dollar, everybody keeps telling me, Kashaf, this bounce is real and this is happening. And people keep saying this is something I would buy all the time. And I'm like, what? Who the hell would buy this thing? Like, nobody would buy this thing. Like if people were like, if this was Nvidia or something, I'm like, if you just literally look at it without anything else, it's way under resistance. It has a lot of work to do to get back to those levels. That's a nasty downtrend. I don't think that's a bottom. We kind of have a W bottom kind of setting up, sure. But the intermarket analysis is telling you that this is probably heading lower as we're in a bull steepening, as liquidity keeps rising. And the Fed continues to cut rates. We're probably in an environment where the dollar will continue to weaken. And also for me, emerging markets, I think, are screaming that that's probably the case, especially if you look at Latin America right now. It looks amazing in comparison to the rest of the world, especially in the last 3 months. The massive outperformance we're seeing is something we only see in weak dollar cycles. So, I want to ask you, like, what are you thinking about the dollar here? We've talked about this ad nauseum at this point. We've talked about it quite a bit, but at the same time, it's like this is always the most important macro piece to me to talk about, because if you get the dollar right, you get everything else right. So what are you thinking about the dollar here? What are you thinking about emerging markets? You got any thoughts on these?
So when Trump came to power, I wrote an article where I said lower dollars here, and that turned out to be a prescient call. And it was also kind of an obvious trade. Like, if you looked at what Trump was talking about, well, he was talking about tariffs and what happened the last time the US imposed tariffs. And then if you look at what is the trade relations and just the fundamentals. So let's walk through the fundamentals. So why do foreigners own dollars? Well, they trade with America and they get paid in dollars, and those dollars then get recycled back into US capital assets. So this pushes up the demand for dollars in terms of investing in the US. And this also pushes up trade with the US because, well, you have the dollars, you prefer them over your local currency, you invest them in the US, you get higher returns than what you would get in your local market. So it's a great feedback loop. And Trump came in and said, no, we are not going to do that. We are going to attack the deficit, meaning we import more than we export, and that's not good. Well, if you look at the Austrian point of view, if you can import whatever you want, produce nothing, just chill at home and do absolutely no work, well, you have achieved utopia. That's what you have achieved. But the fact that you can actually import more than you export means that you can contribute. I wouldn't say contribute, but the fact is you can have a higher standard of living and do a lot less work than all the other people who are competing for a strong currency. And the reason for that is because of the deep capital markets and all the capital that the US has developed. So when Trump came in and said, we are going to throw a wrench in this nice feedback loop where the foreigners give us goods and then they give us the dollars and buy our American assets from us at a high price. So when Trump said this, it was obvious the dollar was going to go weaker. And what happened? Well, the dollar went weaker. So it's an obvious trade. There's no rocket science to it. And what did the foreigners do when they saw Trump coming in and kind of attacking all their countries? Well, they are like, we are going to take our capital, we are going to go back home because the US is not very welcoming to us anymore. And that's what they did. So what did that do? They started selling US assets. They started converting their dollars back into local currencies. That gave a nice boost to the local currencies. Investment coming back to their home markets boosted their equity markets, boosted their asset prices. And so what we are seeing is the end of an era where the US was the beneficiary of the world's capital inflows, and the US is now suffering from global capital outflows. So this is going to be very bearish for the dollar until this trend is reversed. Now, why would this trend even reverse? Because once this trend gets started, why should it reverse? Well, there's no reason for it to reverse. Unless, of course, US assets become so cheap, the dollar becomes so cheap that everyone's like, we have to invest here, even though it's a little riskier, which is the kind of situation which China faced last year. So 2014 to 2024, there was this huge outflow of capital from China. 2014 was when their capital markets bubble burst. So since then, for an entire decade, China had those huge outflows. And 2024, it got so cheap relative to the rest of the world. And this is still the world's second largest economy. So it's a big deal. So when that happened, people decided, okay, a little bit of mean reversion. Let's start buying these cheap assets in China. So they started rotating capital back there. And then it became an obvious trade. And then people started buying China. Then when Javier Milei came to power, people decided, yeah, Argentinian banks are cheap. Let's go back. And on and on and on, wherever people found cheap assets, they have just been rotating out of the US and into all the other cheap assets. Now, there will come a point like what we saw in 2011 where Brazilians would rather vacation in Miami than back in Brazil because Miami is cheaper than whatever the prices are back home. So when you get to a situation like that, that's when this trend will reverse. And I think we have a long, long way to go, because when the markets start correcting, or let's say when they start trending in one direction, they are very, very hard to reverse. So right now we are just in year one of a weak dollar cycle. We probably have a weak dollar cycle for, I don't know, 7 or 10 years before the imbalance is correct and the US becomes so cheap that the foreign capital comes back. That's how I look at it. What about you, Jason?
Yeah, I wanted to add, because Freely mentioned, if we're looking at the dollar, it's kind of hard to understand it based on, if you're just looking at the charts and not looking at the macro. And to me, it's like, okay, let's think of this a couple ways. I'll mention this pattern from Bitcoin 2017, 2018. Everybody will know it and everybody can look it up. Feel free to look up Bitcoin. If you didn't trade it back then, go look it at. So Bitcoin 2017, 2018, we see that huge peak that happens at the end of 2017 going into 18. And then we see it continue to try to hit those old highs once again. It never does. What that pattern is called is a fallen angel pattern. You can see Bitcoin makes it over and over again. Basically, if you're looking at 21 or 2020, 21, if you're going back to, I think it was 2019, it had a bit of a run, did the same type of pattern. And so the dollar is doing that today. And this is very normal. Like the dollar even did that after COVID. It's shorter term and not nearly as big of a move. So you can barely see it on this chart. But basically what I'm saying here is you look at that peak that happened. That's the end of 22. The dollar basically topped when the market bottomed. And that was in October 22. And then we move forward and we get stuck in this range, and it's ranging, and it finally has a last gasp effort. That last gasp effort doesn't hit those highs from 22. It crashes back down and then it continues lower. That's what we call a fallen angel pattern. And that usually means like it's exhausted. You don't have the type of interest in it that you used to have to get it back to those old highs once again. So usually we're in a downtrend. So if we just look at it technically, we can look at it that way. Also, if we look at it and go, okay, this is a big downtrend. This thing moved, from what was that, 10, about 110. I'm sure it got above that. I'm looking at a weekly chart, line chart, so it's not telling me the candlestick. So, around 110, let's say. And then it moves all the way down. Even like a massive move higher in the dollar, like would get it to 104, 103. That's not even half of a retracement at this point. That's not really giving me much conviction in this dollar moving higher. Even this scenario here, like, yes, if you look at a daily chart, it looks like it's moving higher, but this is within, you have to always think of trends like this. There will always be counter trends within the midst of downtrends and uptrends, especially in downtrends, even more so. The reason why you have short covering rallies, you have a lot of things that kind of happen, a little bit of news, everybody gets super excited. So this is always going to happen within the midst of a downtrend. So I do think this thing is just going to continue to go lower. Also, looking at the context, like we're talking about, like Kashop just talked about, international markets, you're seeing where the money's flowing. Not to mention, you're also seeing, like Kashop made a great point about money keeps going to where it's treated best, but also central banks in countries are going where money's treated best, and they don't think it's in the dollar anymore. They think it's in gold. And that's not me speculating. That's like the reserves continue to grow for gold compared to dollars, and now gold is outperforming dollars as a world's reserve currency at the moment. As the world's holding these reserve currencies at the moment. So it's interesting to see gold all the way up there, or even they're even starting to buy different currencies. Even the euro is starting to go up in the reserve holding. So like there's a lot of reasons to say, hey, like people are thinking differently about the dollar now. People are probably thinking a little bit differently about the United States or investing internationally at the moment. But if we were on here and we were just stock pickers and we weren't talking macro stuff, we weren't talking about different countries, and I was saying, hey, Baba's a buy here, or hey, better buy Spotify or any of these things, like you would just go, oh yeah, that makes sense. But because we're talking about money rotating out of the United States, people feel a way about it. And really, like as traders, it's like we're not here to feel anything. Markets are cyclical. The dollar could be the leader in 5 years once again. It could be the leader in a year. I could be saying something different in a couple weeks. Let's say a Fed chair gets in there, which will not happen, but let's say this happens. And they get in there and they go, hey, I'm going to raise rates and we want a strong dollar. That will not happen. But let's say it does. I will come on here and I will change my mind and I will say, hey, we're moving into a strong dollar cycle. Right now, the macro, the technicals, the fundamentals, like everything's pointing to a lower dollar. So I think you just want to continue to understand that fact. It doesn't mean like go in there and fade it and short the dollar. If you feel like the dollar's in an uptrend in your time frame, because short term it is, don't short it. Don't do anything like that. But however, be ready for that mean reversion trade to set up. Like we've seen some pullbacks in some of the emerging markets here. We've seen some pullbacks in things like gold miners and so on. Probably a good time to start picking those up because they will probably rally into year end, especially if the dollar stalls out here and moves lower. So I think this is why we're always looking at the dollar. This is why it's always significant to us and something we probably talk about every show. I probably talk about every time you guys see me, but it will always be a thing for me. So I brought Kashop on today. Like part of the thing I wanted to ask Kashop about, I wanted to ask him a little bit about shippers. This isn't my biggest wheelhouse. Like, yeah, I know some things about it, but everything I know about it, I've learned from Kashop. Kashop was back in, was this 2019? I think it was 19, literally the end of 19 or beginning of 2020. You started talking about shipping stocks and you had a great presentation. I think that was in Acapulco on shipping stocks and where they could end up. And then we have this huge move in shipping. Everybody's all excited about shipping after that. But you were the one really talking about it beforehand. So now I'm starting to see like, tanker shipping rates. It's BWET. So just, the ETF tanker shipping rates. That's at new highs. We're starting to see some interesting things happening in the energy sector. I wanted you to talk about this a little bit. Why do you think, and this happens a lot, and I went back and like back tested this using the Chinese rates and the Saudi Arabia shipping rates and European shipping rates and seeing like most of the time when you see a big move in either the shipping stocks or shipping rates, it usually leads to a big move in the energy sector. Now, I'm wondering why that happens, and I'm sure you could elaborate on that better than I could.
So, yeah, sure. So let's go back to 2019. So the International Maritime Organization proposed a set of rules which they called IMO 2020. And what those rules were, they said that ships need to stop burning cheap fuel, which is high in sulfur, and start burning fuel, which is low in sulfur. So when they made this change, and they either do this or they install something called a scrubber, which increases the capex on the vessel, and that will scrub the sulfur from the fuel. So this was all so-called a green initiative. When they implemented this, now obviously the cost of high sulfur fuel is much lower than the cost of the low sulfur fuel. So when the shipping companies made the switch, it means that they have higher operating costs. Now, what happens when you have higher operating costs in an industry? Well, you typically tend to pass it on to your customers or you go out of business. And in this case, they were successful in passing it on to their customers and shipping rates went up. So, and some other companies had to invest in capex in order to install these scrubbers. So then how do you recover your capex? Well, you charge higher rates. So lease rates went up. So this is what happened. And this led to a lot of the older vessels where you couldn't really justify this capex were taken out of circulation. So what happened was you had effectively a shrinking fleet, and this was bullish for rates. And then you had oil go negative, which you traded very well at that point. And when oil went negative, what traders did was there was no storage at the typical oil storage hubs onshore. So the oil traders leased these tankers and they started storing oil offshore, because as long as they could make a bet on oil recovering and paying for their lease cost, well, they were going to make a profit. So that's what they did. And this made rates go up. The shipping companies made a ton of money, and This continued all the way until I think sometime around 2022 when the energy market peaked. And after that, it's been kind of a lull. It's not exactly been terrible. It's just been okay. So it's neither been a good time nor a bad time to be invested in shipping, because the thing with shipping is you get a ton of dividends. So you still make money that way, even though you don't make money on the share price appreciation. And there were a lot of dynamics. So the company, some of them transport only crude oil, some of them transport the refined products as well, and then there's a mix of the two. So there were a lot of dynamics going around. And then in late 2023 is when the market really took off. And this happened because the Red Sea got closed due to the Iran proxy war. So when that happened, the Red Sea got closed, and the shipping, the ton miles, meaning if you cannot transport your cargo over a shorter distance, then you need to transport it over a longer distance. So the tons transported into the miles, so it's called a ton mile. So the ton miles exploded because ships, instead of crossing through the Suez Canal, had to go all the way through Africa. So when that happened, that effectively shrunk the fleet as well. So you had these two bullish catalysts coming in a few years apart, and then it gets even better. It gets even better because the US government got into the fight. So what they started doing is they started sanctioning vessels which were carrying oil from Russia. And the EU also started doing this. So they started sanctioning these vessels. And in order to put the squeeze on Iran, they started sanctioning vessels which were carrying Iranian oil as well. So earlier they were escaping a little more freely, and then the US clamped down on that. And they did the same with Venezuela. So Venezuela is kind of always an on-off situation. So that's something the shipping market anticipates. But the more stringent sanctions on the Russian oil transporting vessels and the Iranian oil transporting vessels, that started to bite. It started to bite to such an extent that even their regular customers like China and India said, we are going to start complying with the US sanctions, which is kind of unprecedented because China usually gets to do whatever it wants to do. And India, well, they really need cheap fuel, or there's going to be a very, very problematic protests and stuff there. Because so in India, oil prices are the petrol prices are higher than what they were a decade ago, even though oil prices are much lower. So that's a problem that India faces. So they usually do not comply with US pressure, and in this case, they just bow down. So what happened is these sanctioned vessels, well, now they can't find any employment. They can't transport oil into China or India. So what do? Well, you just scrap them. And then you go into the scrapyards, and the scrapyards say, no, we won't take these sanctioned vessels as well. So what this does is it tells tanker owners, let us not get into this riskier trade where we have to deal with all these consequences. Let us just be in the legitimate trade. And all the other vessels that did go into this trade now, well, they can't get back into the legitimate trade. So what's happened is now the effective supply has shrunk. Meanwhile, they are not building enough ships to compensate for this lack of supply. So what you are seeing is secular push for higher rates just due to a shrinking supply of vessels, and it's being exacerbated by all the other geopolitical tensions. So every once in a while you'll see a big spike and then a drop, but then the trend as such is up. So if you're invested in these companies over the long term, not only do you make dividends, but you also get to make capital gains because of this ongoing situation. Now, I don't know how long that lasts, but it's trends like this don't reverse quickly. So we are going to see a point where, so the last cycle, the way it ended was there was so much in new orders that let's say 25% of the current fleet is part of the new orders right now. So let's say there are 800 very large crude carriers, just a approximate figure, and there are 200 on order. Now, what happens when those 200 also come on and this 800 becomes 750? Well, then the effective fleet increases to 950, which is a huge increase. And if the market is not ready to absorb that increase, that's when the next down leg starts. So we are very, very far from that situation because the order book is nowhere close to that crazy level, especially when it comes to tanker shipping stocks. Now, Container shipping, that's a separate story. Container shipping kind of did see a 25% order book, meaning order book as a percentage of fleet was close to 25%. So it got crazy there. The dry bulk vessels, these are the ones which transport bauxite, iron ore, and the like, the grains and all those stuff. So there again, it's a different dynamic. So the gas carriers, the LNG, LPG carriers, so that's a different dynamic. The fundamentals are totally different there. But if you're looking purely at tankers, it's up and up and up. It's a secular uptrend. So it's, I think we're kind of in the middle of it, middle of the cycle. We're nowhere close to the end, and we may just hold in the middle for a long time while the supply and demand kind of try to balance out. So I think we have a long runway here to make money in the shipping stocks, the tanker shipping stocks.
So do you think that, since we're looking at this, and this is an ETF, so we're basically, we're not at the all-time highs by any means for shipping rates, but we're hitting new multi-year highs, which is always interesting, always fascinating. So if we're looking at that, and this usually leads to big moves in oil and energy and so on. Do you know why exactly? Because going back and looking at it, why exactly does that usually precede it? Because most people will hit me up and be like, "Oh yeah, tanker rates moving up is bearish for oil," and historically, that's not exactly what happens. Historically, it usually tanker rates go up. Oil like not saying oil's in a great place right now, just saying oil usually bottoms out around that time. And then we start to see oil move up and the energy sector move up after that. Do you know why that works that way in the cycle? For me, I'm a person like, and this, Kashop, which I'm like, I don't need to know to trade it, but like I always come to you to be like, hey, why exactly does this shit happen? Because you probably actually have an explanation for it.
So it's a question of the number of tons and the miles traveled. So that's why the metric is ton mile. So when you look at what happens when oil prices go up, well, there are two reasons that oil prices go up. One is a supply shock, which is what you saw during the Gulf War and very brief periods like that. But those don't really exist as much anymore. And the second is soaring demand, which is something that you get every year during summer driving season, and you also get it at different times. For instance, there's a refinery fire which happened recently in California. So situations like that, then you get a huge surge in demand which cannot be met. Now, this pushes prices up. So when prices are higher, well, you are incentivized to move your cargo over longer distances. So the ton miles go up. And another way to think about it is, let's say you need to charter a vessel and you're transporting 2 million barrels of oil. Now your transport cost is X amount, and the 2 million barrels of oil, let's say it's now something like $120 million or something. So when that happens, when this 120 million becomes 125, are you really going to quibble over paying an extra 10% in transportation costs? Not really. You're not. So you're fine with transporting it over longer distances. So that's what happens. So when you have increasing demand, but then you're willing to pay more in order to transport the cargo to your destination. So you're okay paying that extra 5-10%. So think of it like trucking. It's the same concept. If during holiday season truckers can charge more because they know there's more demand for inventory at the retail stores, so they can charge more to move the cargo and work overtime. So it's the same concept in shipping. So when you have these bursts in demand where demand cannot keep up with supply and the price goes up, well, then you can move your cargo over longer distances and you make money both ways. So that's why we usually see the shipping rates and the oil prices go hand in hand, particularly if higher oil is demand driven and not supply driven.
No, really good. That was like, it felt like a master class right there, because really it's like I understand it to a degree, but could I explain it that well? Absolutely not. So it's great to just have that out there, because so many people keep coming back to me when I keep bringing this up and going like, hey, this is bad for oil, and it's like, no, that's not technically bad for oil, and it's for the reasons you just laid down there beautifully to everybody. So moving through, and you were talking a little bit about solar demand, and we're talking about lithium, and we're starting to see these moves happen. And this is a thing, like everybody always asks me, and Freely actually brought up a great question, and I can answer this right now, which is, Do you trade lumber? If so, what vehicle do you use to trade it? Also, where does it fit in the commodity cycle? So I trade lumber on the SGX. That's the exchange, Shanghai. It's probably the best place to trade lumber if you're going to do that. But once again, it's a very liquid product. It also doesn't trade as many hours as our futures trade in the United States, so be ready for those things. Where does it fit in the commodity cycle? So this is interesting, and this is what I was getting at here with the lithium chart, which is if we're looking at all the commodities, start with gold, and then we move to, let's just talk commodities. So I want you to talk about miners. We move to silver. We move to copper. We move to, palladium, platinum. Then we start to get to the base metals, and we're talking about copper, steel, iron ore obviously is in there. Then we get to things like aluminum, and then we move past it, and we're starting to get into the lithium products. Now we're starting to see lithium moving, which always makes solar move. So that's also part of that cycle that usually happens before the final piece, which is energy. And where does rubber fit into that? With energy. There's oil. I forget how many quarts exactly. I used to know that off the top of my head. I think it's 4 quarts of oil per tire or something like that. So like there's a lot of oil in tires. It usually moves to the same degree, or not the same degree, at the same time as things like energy and oil. So I would just be waiting for, oil to me really, like, it has to do some work. And we need to get above 80 to get me very interested in oil once again. I like some of the stocks in the sector at the moment, but yeah, I said rubber. That was rubber. Maybe I said it wrong, but I meant rubber. Yeah, there's not oil in a lumber per se, but yeah, rubber is what I'm talking about. So if we're looking at all these things, like, I do think that it just fits into the end of the cycle normally. Iron ore usually kind of moves down there too. Don't know the exact reason why, but on my list, it's iron ore is right next to lumber. So this is going to be an interesting time to see where this all goes and ends up in the markets. But I think like the commodity cycle is working the exact way it should be. Energy is taking a little bit longer than I thought it would, but once again, like, who cares what I think? The market certainly doesn't. Why I keep bringing it up is that it should be on everybody's radar. Get oil, energy, all these things on your radar. Get buy stops set, or put alerts out, whatever it is, for price levels where you want to buy these things, and start getting interested when that happens. And so that's part of the reason why I'm always talking about it. But really, like right now, what I'm trading heavily is like all of these different sectors, whether it's lithium products, whether it's coal stocks are even moving, which is interesting. Haven't seen that in a long time. A couple fertilizer names are moving. Haven't seen that in a really long time. And now we're starting to see the grains move. Corn usually moves with oil. That's also at the end of the cycle. Not the end of the cycle per se, but the last things to move in the cycle. Usually you have a couple years after these moves start to happen. But corn, soybeans, wheat, getting very interested in those areas as well. So continue to pay attention to this. Soybeans already have a buy signal. Corn has a half buy signal for me at the moment. Looking for it to take out those old highs. If you look at a weekly chart of it, you can see exactly what I'm talking about. So it made a 100-day high. Looking at that, feeder cattle actually went short a week or two ago. So that hit a 100-day low, been shorting it ever since. Some news came out. I forget what exactly it was. You might know, Kashop, or you might not, but some news came out where something happened to some company, and they were talking about like cattle, and that's why cattle prices dropped and so on. And really, like, to me, I'm looking at the chart first. I know all these things can happen, but like, I don't have an edge watching the news. Like I couldn't have, got in there and shorted feeder cattle after the news happened. Like it just doesn't matter. That's information everybody has. Look at it from a positioning level. Smart money's getting very short it because it's up so high. Also look at it from a fundamental angle. We look at it like that. We're also seeing that the supply of feeder cattle finally started to go up again, and cattle that all started going up again. So that's good. And then we're making a 100-day low. So put that all together. I'm just going to take the trade. I don't really care about what's coming out in the news. So Kashop, let's get into lithium a little bit because you mentioned solar, and we're starting to see solar actually make a move, which that's been a while. Everybody, if you remember this one, this was always funny, which is it was 2020, and they said if Donald Trump gets elected, buy energy, by banks, by I forget what else it was. It was something else, but just old industrials, old school stocks at that point. And if Biden gets in, you want to buy solar, technology, and so on. And then basically we have the biggest run in energy under Biden right after that. So I always thought that was interesting. And now Trump is in, and now we're seeing solar stocks start to move once again. We did see that during his first term. I did have some long positions in my fund those years for TAN and some of these solar names. So now we're finally seeing solar moving again, lithium moving again. Do you have any thoughts on that? I know it's a sector
So,
I've never heard you talk about it a ton, but I know you know a lot about it.
so solar is moving mainly because so the production happens in China, and with the tariff war and everything, so the supply chain is getting disrupted. So you're seeing the American companies start to move because now they have higher margins. As for lithium, lithium topped out around 2022, and it's kind of been a dull market since. So we are getting a bounce. I don't know how long this is going to last. So look, electric vehicles, those are here to stay. But what is the exact composition of the future of batteries going to be? Well, we don't know, because if you go back to say 5 years ago, cobalt was in the news on a daily basis, and that's because these batteries needed a lot of cobalt. And then there were these news articles about how kids in the DRC were exploited to mine the cobalt, and then all these big giants realized they needed to take cobalt out of their batteries, and then you had a new generation of batteries come in, and the battery tech is going to be increasing at a massive pace. So you don't really know what the future composition is going to be. I'm guessing there's still going to be a lot of lithium in the batteries, and in that case, you're going to see a big secular move, because let's just say the electrified fleet goes from 3% of the current fleet to say 5% to 8%. It's a big move. So 3% to 6% is a 100% jump. So how much lithium are you going to need? How much copper are you going to need? Well, you're going to need tons more of it. So I think we're going to see a secular move, and it's also the inflationary cycle. So a lot of these moves that you see in anything which is industrial related, anything that is commodity related, a lot of it is also factoring in the inflation. So just for factoring in the inflation, if you're getting a 30% move, well, you could have no other reason for it, just for the other than the fact that it's just catching up to inflation. So I think we don't need to read too much into it. It's a bull cycle. Industrials, energy, metals, anything that's real molecules rather than digital, it's all going to do very well. So we are just seeing that trend in action.
No, I think that makes sense. I think it's a commodity bull cycle, and we need to just continue to play that the way it is. Like it's as simple as that. And take the trades as they come. Like I feel like so many people. I could put up a chart of gold moving, copper, and oil will be next, and everybody thinks like that means I'm buying the crap out of oil, which is not the case. It's playing the cycle the way it's coming to me, and identifying that this is how it usually works, and we should follow that roadmap when it's happening. So like once again, the roadmap doesn't say exactly in 14 months this is when it happens. It's basically around 14 months is about 12 months I think is the average. 14 months is the high end of the average. The longest time it took was 17 months. And we're getting closer to that as we move on. So I want to keep this on my radar. I see the refiners are moving nicely. I see heating oil is outperforming for a while now. So that's interesting. So I want to just continue to play the cycle as it comes, take the trades as they're coming to me. And even in products like lithium or solar, like I don't have, like a lot of people are like, oh my gosh, you're such a commodity guy. You hate solar energy and all these things. I don't really care. I'm like, I'm just a trader. Like I will trade just about anything in front of me. If it's in an uptrend and it's breaking out and giving me a signal, it's on my list and it'll be bought. I do not care what it is. So moving to the next one. this relationship, I keep getting told, Kashap, and this makes me laugh every time, which is that maybe bonds and energy are going to start moving together. Um, because we see this little uptrend kind of here. This is basically the Fed dragging the short end of the curve, and not talking about the yields, but the bonds. They're dragging the bonds a little bit higher. And if you're looking at the short end of the curve, it's like up here in comparison. And this is getting dragged just a little bit higher with it. At some point, I would assume like the market catches on to this being very inflationary, and this thing just rolls over hard. And that's when probably energy will break out. I'd assume that happens around the same time. And so when we're looking at this, I want to just say like, hey, like it's why we're I'm talking about patience here, but also like what way do you bet in a trend? Do you bet that this is a primary uptrend? And it's very easy to see that primary uptrend, higher highs, higher lows, longest flag pattern. Just frustrating. Like if you hate energy and you don't want to buy this thing, it's just because you're frustrated and annoyed, and I feel it, and I'm not saying anything against that. I'm just saying the fact that this is a big flag and this is a big downtrend with another big flag. Where do you go with this? Do you think like this is all of a sudden going to reverse massively? Things like that do happen, but is it happening for some reason right now? This reason was big. Why did this happen? Why did this not relationship change, but why did this mean revert the other direction? So we're basically looking at COVID giving out money to anybody who has a pulse, basically. If you had a business and you just, not even a business, you didn't even have to have an LLC. You could just say you had a business and write in for a PPP loan and you get money. Like everybody was getting free money at that point. Not to mention rates were at zero. There was QE infinity. So next thing you know, this rolls over with inflation. As inflation continues to move higher, we see energy start to move up. What's the scenario today? Well, the Fed is cutting rates. Globally, we're cutting rates at a rate that we would normally cut rates in a recession or some sort of a crisis, but we're just doing that today to keep liquidity flowing. So like we have this liquidity environment. We have talks. I don't know if anything's going to happen with any of it, but we have talks of 50-year mortgages. We have talks of stimulus. We have talks of all these things. And money's flowing out of the United States, and the dollar is weak, just like in this period here. So put that all together, it really looks like energy getting over 98. I'm not saying, hey, go out and buy energy today. We get a close above 98, which would be up here. I don't think this thing's looking back for a while. I think this thing's going to take off. So once again, like I'm waiting for these closes. As a trader, it doesn't mean I'm going to get in there and just buy these things because I think things. It's wait for these closes or take the signals as you get. Like we have false breakdown signals. You could take those. You could take a breakout signal here. I think that's the best one to take above 98. Whatever works for you. But if you believe that that's a possibility, bonds are not going to follow it to the upside. Bonds are going to get crushed. And so I'd continue to caution people against buying long bonds. And speaking about bonds, this is a bond yield chart. So we're looking at the yield curve. So when we're looking at the yield curve, what we were talking about earlier is this creates more dollars. It's called a bull steepening. And so basically the banks can lend from the short end of the curve at a low rate can get money from the short end of the curve at a lower rate and lend money at the longer end of the curves. Let's talk about, like, for example, 30-year mortgage rates, and they make money on the spread. So that's how they make money in these type of environments, but also it creates more liquidity in the system as they're able to lend out more money. So if we're lending out more money and the Fed is also lowering rates, as well as globally we're lowering rates as liquidity continues to move, I do think that this is just going to fuel this commodity cycle. And this is a CRB index. This is heavily energy related. If it wasn't just energy and it was a lot of gold and metals, I could be back up here again, but we're not. So we're continuing to wait for that big move. But I think that that's also another plus in this strategy. So Kashap, when we get to leadership, I haven't heard your thoughts on keep kicking my camera. Sorry, guys. I got my dogs under here. When we keep talking about Latin America I want to hear your thoughts. Like, what do you think is the best area in Latin America? What are some of the stocks you're looking at down there? Or do you hate it? Do you love it? Like, what do you think? I mean, not love it because we're
I
traders, but like it.
I like Latin America, but my exposure is primarily through the mining stocks.
Mhm.
So I took a bet on Ecuador a year ago, which has played out very well. Now, Ecuador is one of these countries which people say you should just avoid because of all the negative news that it's had in terms of mining friendliness. And I saw the cycle turn and I went in. It's done very well. Now, of course, Chile has always been mining friendly. So Chile, even parts of Brazil, they all tend to be mining countries. So they do very well in times like this. And that's the other thing. So if you're going into Latin America, if you're going into the commodity producing countries, you want to see a weak dollar cycle. And when you see a weak dollar cycle, and if you look at all these international ETFs, the country ETFs, you will see that they have a lot of exposure to banking. And that just makes sense because in this environment, their domestic banks make a lot of money. So, because like what I spoke about earlier, when you see capital comes back into your country, so then it sits as bank deposits and economic activity picks up because, well, there's a mining boom, there's a commodity boom, if you look at Argentina, there's a boom in cattle. So, you have all these factors that tend to make these countries do very well in a weak dollar cycle. So, you can just buy the strongest ones, you can buy the ones which have the best GDP growth, or if you look at which are the countries that you really know. So, for instance, I know that Chile does very well in the environment like this. I know that Brazil does very well because I've seen what Brazil did during the 2011 cycle. Now, Colombia, I'm not that familiar with. I just have one stock there, one mining stock there. So, that's okay. Austria, Ireland, I'm really not that familiar with those countries. South Africa, yes, I think South Africa is going to be a great turnaround story. So that's something to watch for. Rest of Africa as well. So Africa in general, I think there's a ETF for frontier markets. So
There is. I think
if
it's
you,
AFK. Yeah, it's on here on the bottom. AFK.
yeah. So stocks like that tend to do very well in a weak dollar cycle. So, and it's all interconnected. So why do you get a weak dollar cycle? Well, you get it because investors repatriate their capital back to their home country. And which are those home countries? It is the commodity producing nations. And what are they also doing? Well, they are making a lot of money because commodities are higher, the dollar is lower. And so they make a good amount of money, and then the banks are flush with deposits, which means economic activity picks up. So they're in the good part of the cycle. So think of where the US was from 2001 to 2006. That was a great part of the cycle. So now these Latin American countries and all the other commodity producing countries are experiencing that same kind of or a similar kind of boom in their home economies, and it's being fueled by other US investors recognizing that not only does African capital want to go back to Africa, American capital also wants to get into Africa. So now that's a great place to be for these countries. So you're going to see them benefit from those capital flows as well. So it's a great time to be bullish on international stocks, but you have to pick your spots. So first look at the banks, look at what the banks are doing, and if you like the trends there, then you know you're on the right track. So you can probably weigh the ETFs based on how the banks in these home countries are doing, and then you can pick your spots, or else you can just directly buy the EEM, the frontier market ETF, things like that, or the Latin American ETF, and just call it a day because it's a rising tide, it lifts all boats. So you don't really need to do too much work if you're not in that field. So you can just pick these great products which are not very popular yet as well. So, and that's the other thing that you'll benefit from. So liquidity will improve as the cycle improves and everyone gets into the trade. So there are really a lot of ways to profit off this, and I think we are probably just 1 year into the cycle. We still have a few more years to run.
Yeah, I think so too, and I think people real like we've been talking about it all year, and I think it's globally, like I remember I brought it up on a show, and the person who was on the show was like very like upset with me for even bringing this up, and I was like, it's the truth, which is people talk about the Americans and our home country bias, and it's really a global bias at the moment. Like globally, people just want to own U.S. stocks. It's been the outperformer. It's outperformed for a lot of years. This year, it's certainly not. And I don't think that's going to change by the end of the year. And I think everybody's like not understanding like how significant this is. And really, when we're looking at things, we're talking about the weak dollar cycle. Like when we're talking about that, what I really mean is I'm seeing it show up in international stocks more than anything else. The international stocks are screaming this at us. This hasn't happened in years. Like this hasn't happened since the 2000s, where we get this huge move in international stocks. So now we're here. It's 2025. International stocks are moving after basically a 15-year bear market. So looking at that, I think money's obviously going to be treated here best. We need to continue to look at these areas. Greece is up 70% this year. That's not normal. Like things like that. Like yes, they can be one-offs. Like one or two. I've had one or two international stocks over the last 10 years per year do pretty well. But like 70, you're seeing basically across the board. We're talking about 40% to 70%. That's wild. Chile up 50%, Brazil up 48%, Colombia and Brazil small caps, I feel like those are up like 70 or maybe more. Latin America as a whole is up 50%, almost 50%. A lot of these European countries, which like we've all kind of written off, let's be honest. Like we all were like, Europe's not really going to move. And even myself, like I was like, I can't believe them. I remember buying Poland, and even though Poland's a little bit different, I'm like, I can't believe I'm buying anything in Europe. Italy, I started buying Italy this year earlier. Like these things started to all move in a very big way, and I would assume this is going to continue. Even things like I think we're going to start to see interesting catch-up trades, even like things like Malaysia. I don't know why I have a double on there. I probably messed something up with the API, but anyways, we have Malaysia starting to show some relative strength just in the last month. All these sectors, all these different commodity stocks in these countries and so on, like that's where you need to be looking for alpha, because like our goal is to outperform, right? Like our goal, if my goal is to perform like the S&P 500, I might as well put my money in the S&P 500 and walk away. And the reason why I trade the way I do is always because like the answer and the old axiom for traders, there's a bull market somewhere. There certainly is. But what type of bull market? What's the magnitude? Where's the outperformance? That's the question. And so I'm always looking for that. And so if I find that in international, I'm going to go that way. If I find that in the commodities, I'm going to go that way. If it's in US stocks, I'm going to go that way. Whatever it is, my goal is to outperform. So if your goal is to put up good returns, because at the end of the day, like this is the stuff I want to, talk about a little bit and just think about for traders. At the end of the day, is my goal to help other people, like because I have my service and then I have the fund, and so my clients' money or helping other people is my goal to get them to perform about the same or sell them on an idea. U.S. stocks great forever. I love Japan. Gold miners for life. Is that my goal? I would make a lot more money as a newsletter writer because people would just go, hey, I really like what he's saying because I have my own bias too, and they would all get interested. But if my goal is, hey, I just want to help everybody make money, trade well, and do it, like I'll look anywhere for those trades. And at the end of the day, it's like people will talk about taking money out of the United States, and it's really like, number one, you're not like like these ETFs are vehicles through us. So once again, you're really not. But at the same time, you're not giving, China's not getting, $100,000 from you and going like, oh, we're going to raise up and start a war against the United States. Like that's not going to happen, especially you're a trader. You're going to sell that position at some point. So we're not taking long-term stakes in anything. So really, who cares? And secondly, it's like my goal is, if the goal is to help everybody make money, it's like, yeah, because I want to, your life should be enriched. Like I can't affect the world. I know that. I'm not, I don't have a huge business. I don't have that huge of influence. I don't have any of those things, but what I can do is affect the people around me and help them to become better traders and improve their lives. And when you're making money, like my dog's going blind now. She has these cataracts that just kind of came up overnight one day in a really big way. And so like it's nice for me to just be like, hey, like whatever we need to do, like hey, we need to do cataracts. She's 13. Like people are like, oh my God, why would you do cataract surgery? It's a waste of money. It's like, well, I've made enough money. I've done enough things that like really I want her to have a good quality of life. And like, my mom had a situation where she knocked her teeth out, being able to send her money for that. Like things like that matter to me. And that's why I can affect people around me better than, okay, well, I really like love the United States and I'm actually losing money owning these stocks, but it's okay because like I'm a United States citizen. Like that doesn't make any sense. And so once again, I've explained this a million times. I'll stop there, but like don't be afraid to invest in things outside the United States. Every good trader you've ever read about does it. You have to do it at certain times. And if you're going to do it in a way that makes a lot of sense and makes you some money. So anyways, Kashat, we can move past that if you want, or if you have anything to add, feel free.
Yeah, when you tell me this, so trading is also personal this way, and I just want to bring out one other story which just reminded me of. So George Soros, whom everyone knows for shorting the British pound, and now he's a hero, and he did the same thing during the Asian Tigers crash as well. I think he did it to Malaysia or some other country, I forget now, or Indonesia. And what happened was after that, he got so much bad press that he let it get to his head. And when the Korean won tanked, he personally went and started buying stakes, started talking about how, hey, I'm long the Korean won and, this economy is doing great and things like that. And he absolutely got murdered by the market. And that was a humbling lesson for him. I don't know which book of his he talks about this, but it's in there somewhere, so you can look at his Korean won story. And that's the thing, as traders you cannot put your biases, your guilt, your aspirations onto the market, because the market doesn't care. You're on the right side of the trade, you made money. What the press writes, what other people say about it, well, doesn't make a difference at all, because you made money, that's it. And that's really the scorecard. And that's really all trading is. It's pure dollars and cents. There is no emotional attachment to this. What you take out of it, what you do with your capital once it's outside your brokerage account, well, that's your separate business, and that's where your charities and the other things we like to spend money on, that's where all those factor in. But when you're looking at your screen, when you're on your IBKR account, well, you really can't take all your feelings into account. It is what it is. And let's say you're trying to quit smoking, so can you go short the stock of Altria because hey, I'm trying to quit smoking, which means I'm going to take an anti-smoking stance and short that stock? Well, no, you should not do that. So that's really where it comes in. Like, yes, there's emotions involved, but as traders, keep the emotions to what you do with your bank balance, what you do with their life outside of trading, and not bringing it into perspective in your trading account. So if you feel that whatever the home country bias or whatever you're feeling as well, you have other ways to express it, not with the trades that you put on. So the vanity trades, those never work.
No, great point. And so let's get into this question. We'll probably have dip after this. So thoughts on how to handle when you follow the plan and the move reverses. So we'll have probably two different opinions on this. So Kashyap, you can go first. They said trailing stop hit, but weekly strength seemed to reverse. So anyways, what do you do in this type of situation?
So when you get into a trade, you already know when you're going to exit. So in my case, I trade a lot of the small cap stocks. So my exit is twofold. One, it reaches the valuation level where I think it does not make sense to hold on anymore. Or two, it gets acquired. So these are two situations. And then the third situation is when I feel I'm already 100% long and I don't really want to add leverage. So I need to cut something in order to add something I like better. So those are the three exit scenarios. Now, what you are asking is you follow your plan and the move reverses. Well, if you followed your plan, then how does it matter what happens after? because stock prices, that's a continuous stream, and all you really need is the entry and your exit and what you get out of it, because you're not going to hold forever. So how does it matter whether the move reverses or the move continues? You had your plan, you executed it, you made money or you lost money, and then you move on to the next trade. That's it. So there's no point in thinking about holding something forever, because let's face it, no one's going to hold anything forever. Maybe you own your house forever. That's it. Maybe you own physical gold forever. That's it. Stocks, are you really going to hold it forever? Not really. So just forget about it and move on to the next one.
That's well said. The only thing I would add is, if you're looking at, like, for example, when I first started trading, like a lot of things, and using a more systematic method or a more planned out method, let's say, to answer this question, I would go back to these things and go, like, what did I do anything wrong here? For example, like, let's say I got stopped, like you said, you said trailing stop hit, but weekly strength seemed to reverse. Number one, this is going to happen all the time. This is going to happen constantly to you as a trader, and everybody that trades, this will happen to you. Meaning, you're going to be in a trend, your stop's going to get hit, and then it's going to move higher, and like you have a choice, like Kashop said, like either you move away or not. And I think the answer is always just move on. But the other answer is, can you go back and see why that happened? So if you're looking at it, and for me, this is the reason why I'm so long term. At the beginning of trading, I traded off of daily signals. I was much more short term in my signals, especially when I became more systematic. And so, like, this seemed to happen to me a lot. And I wondered at the end of the year what my returns would have been if I would have had a wider stop loss or done something a little bit different. So I would go back, and then I'd look at it and go, okay, I would have had much better returns. The volatility would have been higher. So, it just depends on what your goals are. Some people, their goals are to have very low volatility because they can't handle that type of stress. Some people, their goals are to make really great returns. I'm not saying one's better than the other. It's just what it is. Like, you have to trade what works for you. For me, I don't mind it. I always kind of look at what the returns could be. And so then I started to back test. Okay, what if I use weekly signals? What if I use weekly closing signals? Because sometimes you're going to have these huge intra-week moves that go down and bounce around and do stuff and get stopped out. But what if I waited till the end of the week on Friday to let my stops actually hit? And you can make these orders or conditional orders on most of your brokerages to do this. So what if that hits at the end of the week instead of during the week? And I found out, okay, well, that's much better. And even on a shorter term time frame than me, you could do this daily. Like, okay, what if I just let the daily closes tell me what it is? And then also looking at the ATRs. If you're using ATR trailing stop, then you'd go, okay, well, can I make this wider? If I go to 6 ATRs instead of 5, what's it like? What about 7? What about 8? What about 10? You can do these types of back tests, and they will tell you like how you could have positioned better for what's coming. And like, I really think this might be boring to some people, but this is like really, really important. And I'm so glad you mentioned this question, because it's something that, if you can get an understanding of this one way or the other, it could just be the answer, like Kashop said, just run, get out. That could be the answer. The other part of it could be, hey, maybe I want to be more long term. And the other part of it is, maybe your system's completely perfect and you just run it the way it is because it fits your personality, and you just learn to move on to the next thing. That's something also that's the most important lesson that we have to get as traders, because I think this is part of the reason why I trade so many products, is because it's like, something gets stopped for me, I'm just like, I don't even care. I don't even think about it anymore. I have like 9,000 other things that could give me a position any day. So think about it that way, but also think about how you can possibly restructure your system if you need to. So a couple ideas there. Great question. Love that came up. Somebody asked. Okay, we'll
So
get.
before we move on,
Go ahead.
sorry, I just had a question for Jason. A
Mhm.
1080 stop, is that really a stop?
Oh yeah.
It's too wide, isn't it?
Nope.
No?
It depends. So it just really depends on how, when you're really working at this, like, so for me, for example, and I started thinking about this when I used to talk to Jerry Parker a lot, probably was it 4 or 5 years ago. And Jerry would talk about the fact that he, used these very wide stops, and the thing that's changed for him over time, like if you think about the old turtle trading system, it was buying 50-day highs and selling 25-day lows. Like if you tried to do that today, you would get crushed. But like they made a ton of money doing that, a ridiculous amount of money actually. So what changed over time? Well, the markets, one, high frequency trading makes it so there's a lot of chop, makes things a lot differently. Hedge funds really started focusing on that 1 month performance. This is why hedge fund performance went down a ton. They started focusing on low volatility, and they started focusing on that short-term performance month to month, so they could show their clients how their monthly returns were great or whatever, and so their clients would love them. And so basically it made it so there's not quite an edge in that short term anymore. So like Jerry always talked about, like he had to go more long term and more long term, and like part of the thing he's just done over time is he runs the same strategies, but they're just more long term, and he finds an edge there. And really, like for me, after that, I was like just back testing that and back testing that and back testing that and going, holy crap, like if I was to take all my strategies and make them way longer term, take my positions down by a ton, take my position sizes down, because if you're shorter term, like you can have bigger positions, for example, because the stop will be closer. And if you're longer term, you're going to have a wider stop. So take my position sizing down, make sure it's set up in a way that I can really catch these trends and ride them, and I'm going to make a lot more money. And that's been the case. And I think like basically since then, my returns have been really, really, like really outperforming. Even in the years that I would think that are pretty choppy, the returns have been really, really solid. So I think that's like always an edge. And I think something we all kind of do naturally. Like I think over time, like even talking to like day traders, like who've done it for a long time, like they move into I'm not a big fan of day trading, but I'm just saying they move into even longer term within a day. And then not to mention most of them, not some of them, most of them move to, okay, I'm going to swing trade now, or I'm going to go weekly and so on. And same way with us as traders, like you usually start out more short term, you move longer. And it's just because the trends are going to be wildly easier, like ridiculously easier to trade. So let's get to the last question. So how do you use TLT as an indicator to understand the broader market? So Kashab, you can answer that first, and then I'll end it, and then we'll probably get out of here.
So I look at bond futures. I look at the actual yields rather than TLT. But the way you can use it is, let me see how to put it. So you have to look at the 2 year, the 10 year, and the 30 year. So look at how they are moving. So now what Jason was talking about earlier, the bull steepener. So the bull steepener trade is, think of a booming economy. So in a booming economy, you're going to be charging a lot more to lock up your capital for 10 years and 30 years rather than short term. So this is exactly why the banks make a lot of money in those times. So they borrow at 3%, they lend at 6 or 7%, and they make the spread. So in that situation, what would you be seeing? Well, you would be seeing the short-term bonds doing slightly less, performing slightly less compared to the long-term bonds. So now this is a normal economy. This is a healthy economy. Now you have the other scenario where, let's say you're in a recession. Now, when you're in a recession, what happens? People flock to the safety of bonds. And that's the period where the credit market dries up. So the intra-bank lending dries up. So this is exactly what we saw in 2008. This is exactly what we saw in 2023. So in that scenario, what happens? Well, you see a lot of money flood into treasuries and you see the yield curve invert. Now, when you see a situation like this, what does it tell you? It tells you that there is stress in the market. So that's one way to read it. The other way to read it is what happened in Europe back in the previous decade. So you had rates going to zero and then rates going negative. So your long-term bond yields went negative. So why does that happen? Well, it happens because of some other fundamental factors. So for instance, at that point, Europe had this whatever it takes policy in order to pump liquidity into the market. The Swiss National Bank, the European Central Bank, they started charging negative rates on deposits in order to push the banks to lend. So you had these structural issues which was causing yields to go negative. So you really have to take it case by case. Now, I think negative yields is a very one-off phenomena, but you really have to take it case by case and you have to understand why the bond market is doing what it's doing. So I wouldn't just look at TLT. I would look at the 2 year, I would look at the 10 year, I would look at the 30 year, and then I would take a call based on what I'm seeing. So it's a totality of the factors and not just one single indicator.
No, I agree. I think it's you have to really understand bonds. Number one will tell you a lot about the market, tell you liquidity, tell you all these things. Usually where bonds go, like for example, this correlation here, like where bonds go, let's say bond TLT goes down, energy's going to go up. But without the context of understanding what the short end of the curve is doing in comparison, let's go back a little bit because I think we were talking about that yield curve. I don't remember even where it is. I think it's forward. So we're talking about the yield curve here. And let me get this alpha here so everybody can see it. So when we're talking about the yield curve, it's this is what I mean by looking at bonds, and this is what Kashat meant by looking at. This is a 3-month, 10-year. You can look at the 2-year to 10-year, whatever you want to look at. But this basically is showing me, okay, what's the lending practices of the banks at the moment? Well, the banks are lending heavily when the green arrows are going up. At least they can lend better at those points. The yield curve coming out of inversion, that's usually a good sign for liquidity, usually boosts commodity prices. That's why you see this correlation being really tight. This is also, this is called a bear flattener. And when you get a bear flattener, that's when the dollar gets strong. So you can understand like, okay, the dollar is going to get strong in these type of environments, this type of environment, and the dollars should be getting weaker in these types of environments. So understanding those things in the intermarket, then you could go, okay, if the dollar's weak, international stocks do well. And then if the dollar's weak, gold miners will probably be doing well and so on. So you can kind of go through and have like some intermarket ideas from that. But yeah, you definitely want to look at the whole curve if you're going to take that, for example. And then also, okay, what's this going to do to the dollar? Because it really doesn't tell me like, hey, what are stocks exactly doing here? Because the dollar can go up with U.S. stocks, especially. Dollar can go down and U.S. stocks go up. Like it can do a bunch of things. But understanding it in this context of, okay, well, this is what's happening broadly in the bond market, which should continue this move in the dollar, for example, which is what I'm looking at now, is going, this should continue this weaker dollar move more than anything. So I think it's going to be something that you just have to really learn about, continue, like look up those words, bull steepener, bear flattener, understand what the bond market is really means and what it does and how it functions, and look up things like LIBOR rates and repo rates and all of these things. Like look up all these terms, figure those out, and like you're going to be a better trader than most people out there. Like most people don't know any of this stuff. They don't look at the bond market because it's confusing and it's hard to understand, but really it's easy to understand. I'm not the brightest person on earth and the only person to ever figure out the bond market. Like plenty of people do. It's just the terminology is hard to understand at first. But once you understand the terminology, it's like, okay, bull steepener, bear flattener means this, means that, and figure out like how you're going to trade from that information going forward. So,
And
all right,
to add
guys.
to what Jason
Go ahead.
said, just a last point. So, to add to what Jason said, not just the bond terms, go to the Fred database, the St. Louis Fed. They have this database. Just go query everything. Go ask ChatGPT, Grok, your favorite AI, what all those terms mean. Feed it those charts. Ask the AI what it means, and you will learn a ton that way. Now, we had to learn all this by reading our textbooks and doing all the research on our own because we started doing this before ChatGPT. But right now it's very very easy for new traders to catch up to our level of knowledge just by going through all these free resources. And speaking of the Fred database, you should also start looking at Koifin, because if you're looking at intermarket relationships, then that's another great website where you can start to explore these. And again, the same thing, like you look at the data, then you ask ChatGPT to make sense of it for you, to explain it for you, and you will really, really progress in understanding the macro and understanding how you can use it for trading.
No, great point. So, all right, guys, we're going to end there. Thanks for joining us today. We're on every Friday. Check out last week's one. I know on YouTube it looks funky because there's 2 that came out. I have no, and not to mention, we filmed it vertically. StreamYard changed their technology. I think we got it right today. I haven't looked at YouTube yet. But that was a video with Ian Cully. Ian came on. We talked about commodities cycles, had a bunch of charts. It was really fun. So definitely check that out. And me and Kashap will be back next Friday at 10 a.m. Eastern time. We'll see you guys then.